Tax havens have become a significant factor in global finance as they serve as avenue to help foreign corporations and individuals pay little to no tax. While it is often seen as a smart tool for wealth management and tax efficiency, tax havens can have devastating consequences for developing economies. In this video, we will examine the features of tax havens, their impact on developing countries, and how global cooperation and reforms are needed to address the challenges they present.
Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of TaxMobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos.
What are tax havens? Tax havens are jurisdictions or countries that offer low or zero tax liability, attracting individuals and corporations looking to minimize their tax obligations. These regions often operate under strict privacy laws, making it difficult for other governments to trace funds, ownership structures, or business activities. Notable examples include the Cayman Islands, Bermuda, and Luxembourg. Three key features of tax havens include: 1. Low or zero tax rates. Tax havens attract businesses and wealthy individuals by offering significantly lower tax rates than their home countries. 2. Financial secrecy. Many tax havens enforce strict confidentiality laws that protect the identity of account holders and company owners, enabling asset protection and privacy. 3. Favorable legal frameworks. These jurisdictions often have legal structures that allow the easy incorporation of shell companies or trusts, which are used to shift profits without real economic activity taking place in the tax haven. The existence of tax havens presents numerous challenges for developing countries. Some of the key impacts of tax havens on developing economies include: loss of tax revenue. Multinational corporations use techniques like transfer pricing and intellectual property licensing to shift profit to low-tax jurisdictions, allowing them to avoid paying tax in countries where they actually do business. This deprives developing countries of critical tax revenue that should be used to fund public services like healthcare, education, and infrastructure. For example, companies operating in countries like Nigeria or Kenya might declare profits in tax havens like Mauritius, where tax rates are much lower. Capital flight. Tax havens often attract high net worth individuals from developing countries who seek to move their wealth offshore to avoid taxation. This capital flight reduces the funds that could have been reinvested in local businesses, infrastructure, or real estate, slowing economic growth. This wealth remains offshore, doing little to improve the economy of their home country. Increased inequality. Tax havens make income inequality worse by allowing the wealthiest individuals and corporations avoid taxes, leaving middle and lower income people to pay more. Shifting tax burdens onto the poor can cause social instability in developing countries, as the growing gap between the rich and the poor creates economic and social tensions. Undermining governance and rule of law. The secrecy surrounding tax havens opens the door to corruption, money laundering, and illegal financial activities. In developing countries, public officials and elites can hide illicit wealth, eroding public trust and weakening the rule of law, especially in nations already battling corruption and weak institutions. Distortion of global competition. Multinational corporations that use tax havens have an unfair advantage over local businesses in developing countries. By avoiding taxes, they can undercut smaller domestic businesses that must pay the full tax burden. This distorts competition, stifles local entrepreneurship, and makes it harder for developing economies to nurture successful businesses. In order to mitigate the adverse effect of tax havens on developing economies, there is need for strategies that involve both local and global corporations. Strategies for mitigating the impact of tax haven include global cooperation. International bodies like the Organization for Economic Cooperation and Development (OECD) have developed frameworks such as the Base Erosion and Profit Shifting (BEPS) initiative to curb aggressive tax avoidance. These initiatives seek to close loopholes that allow profit shifting and to increase transparency in global financial reporting. However, the success of these initiatives depends on the willingness of both developed and developing countries to uniformly enforce these rules. Strengthening domestic tax law. Developing countries can enhance their ability to capture lost revenue by strengthening tax laws, particularly around transfer pricing and capital flight. Participation in international tax information exchange agreements can further help these countries track offshore accounts and recover lost tax revenues. Public-private partnerships. Governments in developing countries should collaborate with international organizations, financial institutions, and private sector stakeholders to promote transparency and fair tax practices. By working together, they can pressure tax havens to reform their practices and reduce the outflow of capital from developing nations. Encouraging domestic investment. Developing economies must create favorable conditions for local investment by offering competitive tax incentives, improving business environments, and ensuring legal certainty. This can help retain wealth within their borders and reduce reliance on foreign aid and external borrowing. Now, to gain deeper insight into the impact of tax havens, let's consider the opinion of an expert. According to Gabriel Zuckman, a leading economist, developing nations loses billions annually due to profit shifting and offshore wealth. His research calls for global tax reforms to help developing countries retain more of the wealth generated within their borders. Tax experts also point out that many developing countries lack the necessary infrastructure and resources to combat sophisticated tax avoidance schemes. They advocate for stronger international tax enforcement and transparency measures to ensure developing economies are not left behind in the fight against tax avoidance. Recent events like the release of the Pandora Papers and Panama Papers has brought the issue of tax havens to the forefront of global discussions. These leaks revealed how the global elites, including politicians, business moguls, and celebrities, use offshore accounts to evade taxes. This has fueled global movements advocating for tax justice and transparency, with growing calls for reforms that would significantly benefit developing economies. The ongoing effort of the OECD and the United Nations Conference on Trade and Development to tackle illicit financial flows, especially in Africa, signal that global momentum is building towards addressing the negative impact of tax havens. Impact analysis. The financial losses developing countries suffer due to tax havens are staggering, with Africa losing an estimated $50 billion annually through illicit financial flows and profit shifting. This deprives governments of the resources needed to meet the United Nations Sustainable Development Goals, including poverty reduction, health improvement, and infrastructure development. Also, the use of tax havens worsens inequality and stifles economic growth, limiting opportunities for sustainable development. While the financial impact is severe, the effects ripple down to local communities. Community impact. The most significant community level impact is the loss of essential public services due to reduced government revenue. Education, healthcare, and infrastructure projects are often the first to suffer when tax revenues decline. Additionally, the erosion of public trust due to corruption and financial secrecy in tax havens contributes to social instability, making it harder for communities to prosper. Having explored the various dimensions of tax havens and their effects, let's summarize the key takeaways. 1. Tax havens drain developing economies. They deprive nations of critical tax revenues that could be used for public services and infrastructure development. 2. Global reforms are needed. Initiatives like the OECD's BEPS are vital, but developing countries need stronger enforcement and greater capacity to benefit. 3. Collaborative efforts matters. Partnerships between governments, international organizations, and the private sector are crucial to promoting transparency and reducing the negative impact of tax havens. 4. Support domestic growth. Developing economies must improve their business environments to retain wealth and reduce reliance on external financial support. With this insight in mind, let's consider the actions that various stakeholders must take. Governments: strengthening domestic tax law, participate in international tax reform initiatives, and increase transparency. International organizations: provide technical assistance and capacity building support to developing countries to combat illicit financial flows. Corporations: adopt responsible tax practices, contributing to the long-term economic health of the countries where profits are generated. Citizens: advocate for stronger governance and transparency to ensure public funds are used to benefit society. Comparative analysis: developed nations with stronger tax administrations and greater resources are better equipped to combat tax avoidance. The United States, for example, has introduced the Foreign Account Tax Compliance Act (FATCA) to track offshore accounts. In contrast, many developing nations still struggle to implement similar measures, making them more vulnerable to tax revenue losses from tax havens. In conclusion, tax havens, while beneficial for certain corporations and individuals, cause significant harm to developing economies. By draining tax revenues, facilitating corruption, and exacerbating inequality, they hinder sustainable economic growth and development. Global cooperation, stronger domestic tax laws, and public-private partnerships are key to reducing the negative impact of tax havens on these vulnerable economies. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.